as we look back over time, the best gains in the market come when you have these sustained periods without big swings. Welcome to Townhall Takeaways, everybody. Happy Thursday afternoon. Willie Dulwich here to walk through what I think are some of the most important takeaways from this week. Try and distill everything we've seen, we've digested, we've experienced in the market into a couple key takeaways to think about as we go forward. So I think one of the first ones, one of the big issues that I've been talking about, I think remains relevant, is investors struggling to move on from 2022. What do I mean by that? I mean, we saw the volatility of last year, we saw the weakness of last year, and that put investors in a pretty bad mood. Pessimism remained kind of persistent all year. We AAII data, we had now have 43 weeks in a row of more bears and bulls. Haven't been able to break above those August highs on the AAII bull bear spread or the Investors Intelligence bull bear spread. We did see that today in terms of active investment managers, but overall the mood has remained pretty quiet. And if we're going to see a bull market, I think we need to have bulls participate. We need investors to move into the market and embrace the strength. And it seems one of the big things that's holding them back is kind of the hangovers from last year, this volatility that we saw last year, all the big 1% moves on a day-to-day basis, the 3% moves that we saw on a week-to-week basis. And I think we're still seeing that as we look at the data. We're continuing to not be able to get more than a couple days in a row without a 1% swing in the S&P 500. I think 3 in a row is the most we've had recently. We had 7 in a row back in November, but it seems to still be the case that you have a couple quiet days and you have a big day, a couple quiet days and a big day. And as we look back over time, the best gains in the market come when you have these sustained periods without big swings, not big losses, but big swings in either direction. 2016 and 2017, you had extended periods of the S&P 500 moving less than 1% on a day-to-day basis. Again, 2018, 2019 into the COVID highs. Not off of the COVID lows, but the second half of that rally, late 2020 into the early part, the late part of 2021. Again, you saw those sustained periods of basically quiet in the market. I think that allowed investor confidence to rebuild. And the absence of that quietness right now has kept investor mood kind of in the toilet. And I don't think that that's good for the market. If we can get some quietness, and that's going to be hard to do in the macro environment that we're in right now, but if we could get less day-to-day volatility, I think that's where we could start to see investors move back into the market and really start to see evidence of sustained strength, which is what we have seen in the past. Investors moving into the market, optimism rising, volatility moving lower, and prices seeing sustained strength over time. So that's a takeaway. There's a reason that investors haven't embraced this rally. It's because it's remained volatile. Another thing to focus on as we go into another round of another FOMC meeting next week is this disconnect between what the Fed is saying and what the market is saying, what the Fed is pricing in or positioning for, what the market is positioning for. And it's a big game of chicken right now between the Fed and the market. You can look at it from a dot plot perspective. Virtually everybody on the Fed is expecting Fed funds rate by the end of this year to be above 5%. They don't lay it out on a meeting by meeting basis, which we can get from the in terms of the market expectations. But the language from the Fed is no rate cuts this year. Fed funds rate above 5% by the end of the year. You look at where the market expects the Fed funds rate to be over the next few meetings, and then by the end of the year, rate hike next week, maybe one more rate hike after that, and then easing by the end of the year. The 50 to 75 basis point differential between where the market expects the Fed funds rate to be at the end of the year and where the Fed has talked about the Fed funds rate needing to be at the end of the year. So that disconnect, I don't think, unfortunately for investors, is going to lead to less volatility. There's going to, one way or the other, that gap is going to close, and it probably comes with a volatile market, which, again, unfortunately for investors, probably means keep having them stay on the sidelines because you're not getting that quiet environment that I think would be evidence of healing. Which way it ultimately goes, I don't know, but experience and data tells me not to fight the Fed. Almost all of the gains in the market have come going back, 30 some odd years, have come when the Fed has been, and its global friends have been cutting rates, not raising rates. So it's not an environment where I want to push back against the Fed too much. Maybe the market's right. Maybe the Fed will shift. But I'd like to see evidence of that before assuming that it will take place. And then the final takeaway, talk about improving market behavior so far this year. 16 days of more new highs and new lows is certainly encouraging to get that right out of the bat so far this year. We could end up with more days of new highs, new lows in the first month of this year than we saw the same number in the first month of this year than we saw all of last year. And it's not the intensity of them that matters. There's not many new highs or new lows in either direction, but just the persistence of more new highs than new lows. That's encouraging. Now it's up to the price action to start to really improve. We need to see higher highs now to confirm some of this strength we've seen beneath the surface. We need that echoed in the indexes. So we need trends to turn higher. We need prices to be able to put in higher highs. And until we do that, I think it makes sense to, you can embrace this rally from a tactical perspective, but in terms of saying, yeah, the long-term trend has changed, that's premature if the longer-term trends haven't changed, if we haven't made higher highs. And so on the S&P 500, and really a lot of US indexes, that means getting above the December highs and then ultimately getting up to those August highs. Just in terms of perspective, in terms of operating, if we're on the S&P or any other thing, probably if we're between the highs of December and the lows of December, probably noise. Longer term, if we're below those August highs and above the June lows, probably noise from a trend perspective. So let's see if we can build on the strength that we've seen already this year and start to not just have higher lows, but actually kind of confirm that with higher highs on the S&P 500 and whatever the index of your choice is. So those are the takeaways. Volatility continues to be out there as a headwind to investors embracing this rally. Fed's up next week. Probably go 25, but I expect them to push back on this idea that they'll be easing by the end of this year. And we want to build on the strength we've seen so far this year, not just seeing more new highs and new lows, but actually seeing higher highs on the indexes as well. Those are the takeaways. Thanks for tuning in. Thanks for joining. Willie Delwich. I'll be doing this again next week, right after the Fed, a day after the Fed meets. So we'll have plenty to talk about, plenty of takeaways, I'm sure, a week from today as well. Thanks for tuning in, and we'll talk to you again next week.